good evening, whatever time zone you happen to be in. Again, this is Dave with the Bright Line Trading System. Today I'm going to be covering my options trading room. I have a live options trading room, as well as an options text alert service that we'll want to cover. And I'm going to spend some time as we go into the webinar here. I'm going to go over our results from our service over the last couple of years, and as well as I'm going to spend some time on what I use to trade options over earnings. It's a little unusual. Probably it's the only way I know to be consistently profitable when you're trading earnings. There's been a lot of earnings trades out there that people traders try to use, but this I've been using for about 2.5 years, and it's been consistently profitable year after year. So I'm going to share that with you, and I hope that I hope to be able to apply that to your trading. So again, I'm Dave with the Compass Options Room here. We've got a couple minutes. We're going to get started. And again, thanks so much for coming here today. You should be able to see my screen and hear me okay. We have questions here. I'll keep the question box up during the webinar. The webinar will be recorded, and I'll keep the question box up in case I come across questions that are pertinent to what I'm talking about at the time. If they're not, but they're general questions, I'll try to catch those all at the end. So again, just pop your questions in there, and we'll answer them as best we can and as quickly as we can. So again, good afternoon, everybody. A good day, everybody. I hope you're all having a great Memorial Day weekend, and I will be back here in just a couple minutes to get started. All right, as we gear up to get going here, let me just, again, I don't really talk about myself or my career very much as far as trading is concerned, but I get a lot of questions from folks about that. And so I'll just relay a quick story before we get started. I've been full-time trading about 14 years. I had been trading part-time before that for quite a while before that. It took me a long time to develop strategies that were consistently profitable. But the way that a lot of folks when they go from part-time trading to full-time trading, most people don't, but the ones that do, they plan it out, and when they get to a certain level, they figure they can go ahead and quit their job and start trading full-time. My story was a little bit different. I was working in IT, information technology, in a cloud computing company. A good friend of mine owned it. About 14 years ago in December, they ran into some financial problems as far as cash flow was concerned, and they had to lay me off. It was about 2 weeks before Christmas, and they laid me off for 2 weeks before Christmas. So I kind of looked at it as an opportunity to go ahead and stay home and trade. And that's I've been wanting to do that, and I gave me the opportunity. So I traded through the end of December. It was over Christmas and New Year's, not the greatest time to trade, but I did okay. But in January, I had a really good month in January trading full time, and then February also became a successful month. And about 3/4 of the way through February, about 2 or 3 weeks into the month, my boss called me back and said that the cash flow had improved, things were picked up again, and I could come on back to work starting on Monday, and he'd look forward to having me back. And I said, I appreciate the offer, but at this point, I really can't afford to come back and work for anybody anymore. The trading has become what I'm doing full time, and it's much, to me, it was much better than trying to work a full-time job at the time. So that's how I get into it. It's a little bit unusual. I didn't really plan it. I kind of get pushed into it. I'd been thinking about it, but it was not something I was going to transition to that quickly. But anyway, that was about 14 years ago, a little bit more at this point, about 14.5 years. And I haven't looked back since. I've been trading mostly options, but some stocks, and developed some really effective option strategies that we use in the room and on the alert service that I'll go over with everybody today. And one of the things I'm going to talk about is the Compass system. The Compass system is a system that right line developed that actually helps me to identify when institutions are in the trades and when they're not. And that's really, really critical as we'll get into the webinar. So again, good afternoon. We'll get started here. And again, thanks so much for spending some time here on a Saturday with me. So again, I'm Dave Wise with the Compass system. I have the Compass Options Trading Room and an alert service. The trading room is open every day. I start usually about 9:15 or so. Open up, so I'm there from market open to market close, and I have lots and lots of members in there, and they post trades that they're interested in, or they ask questions, and I post all my trades that I'm taking in the room, and I will answer questions all day long, looking at charts and sharing charts with all the members. So that goes on all day. So it's one of the few rooms I know about that actually has somebody in there guiding you as far as trading is concerned from market open to market close. First I have to do is do the disclaimer here. All signals and trading opportunities we provide are for educational and demonstration purposes only. Trading is very risky, so you should never trade with more money than you can afford to lose. And neither myself or Right Line Trading are licensed financial advisors, so we won't be giving financial advice. Okay, so if you have any questions or you'd like to learn more, you can always put your name and phone number in the chat box or in the question box, or your Skype username. And if I can't answer the questions, Rory will give you a call back and answer any questions you have. He's not going to try to sell you anything. He's just going to be there to answer questions. All right, and there's a phone number there if you want to get in touch with him. I'll put this up a little bit later on. Now, this is just a graphic of the Compass system I'm going to get into. This kind of shows you the Compass charts. I have mine running on Thinkorswim. Compass runs on Thinkorswim or on NinjaTrader. It does track institutional money flow, and we'll go over that. All right, and this is basically just a graphic of what the alert service looks like. You get an SMS text alert services to your phone, and for those who can't sit in front of the computer all day to trade, we'll get you those trades on your phone, and very timely. I'm on the service, so I can always see how effective, how quickly they're going out. Usually it's about 30 seconds or so after I put it in there that they come out. All right, so that's the alert service. First thing I want to talk about, I always go over this when I start a webinar, is I want to go over what moves the market. And a lot of traders may not be aware of this. This is just a graphic representation of us retail traders right here with these little marbles. And we as retail traders, we can't move the market. We trade, but we can't move the market. And if we're trading by ourselves without the institutions, and this is the institutions back here, if we're trading and the institutions aren't trading, then you're going to get a lot of chaos and you're going to get a lot of chop. You're not going to get any kind of a smooth trend that you can trade. So we don't want to be in the market when just retail traders are in there. We want to be in when the institutions are in. Now, who makes up the institutions? The institutions are made up by big investment banks: Goldman Sachs, Morgan Stanley, JP Morgan. You could probably think of a dozen or more big investment banks. Now, these investment banks have traders. They have trade desks and trading rooms. They also have algos. They all have algos, which are basically computerized trading systems that identify specific information, specific criteria on a stock. A lot of times it's moving averages. A lot of times it's a VWAP. There's a lot of things that they look for, but they will trade based on that. And that's where about 85% of the trades that are put into the market come from. So when the institutions are in there, we want to know that they're in there, because that's when we want to trade. We basically want to follow the institutions and basically pick up the breadcrumbs. When they're driving the market up, we want to be in there. When the market driving the market or the stock down, we want to be in there. We don't want to be in there when they're not trading. We don't want to be in there with just the retail traders are in there. So that's really, really important. And that's one of the things that the Compass system helps us do. In the room and for the alert service, I have a couple of easy rules to trade by here. We trade the best and skip the rest. That means we're only looking for the very highest probability trades that we can find. So we're not doing a lot of trading. Second thing is, our objective is not to make trades. Our objective is to make money. I mean, too many traders think that when they're a trader, they're sitting there in front of their computer, they need to be in a trade all the time. It's not true. You only want to be in a trade when you have the edge. You don't want to be in trades when you don't have any edge. You're just basically just putting money in there that you're going to lose, and you can get chopped up very badly. So again, that's very important, which means we have to be patient, and we don't want to be suffer from FOMO, fear of missing out, jumping into trades just because the stock is ripping higher. Is it really a good entry place? We don't know. We have to wait and try to find that. Okay, and we, as a profitable trader, as a profitable retail trader, we need an edge over other traders, other retail traders, because that's who we're trading against. We're not trading against institutions. We're not going to take money from the institutions. We're going to take money from other retail traders. So we have basically 4 edges here. We have the right line compass system that I'll show you. That basically lets me know if the institutions are in the trade or they're not in the trade. That's really important. And then we also trade what's called relative strength and relative weakness. Now, this is not what you've heard like RSI as an indicator. Relative strength and relative weakness is not that complicated. What we really do is we look at the stock's movement and compare it to the S&P 500s or the SPY movement. If the SPY is moving sideways and down, and the stock you're monitoring has been moving up consistently as the SPY moves sideways and down, you've got relative strength, and vice versa for the relative weakness side. These two things together give you a massive amount of likelihood that the institutions are in that trade. In the 97, 98% likelihood that institutions are in the trade when these two things line up. So that's really, really important. Then we want to trade with the market trend if there is one. And a lot of times there aren't. You get gap ups and then market will move sideways. But if there is a market trend, we want to lean toward that direction. So if the market is in a bullish trend, we want to trade bullishly. That applies to both day trading on the 5-minute chart and daily on the daily chart. If there is no trend, then we lean on the stocks to look for stocks that are the institutions are trading. And the last thing is we want to buy at support or near support and sell at or near resistance. So we don't want to be chasing stocks when they're moving up fast or moving down fast. We want to wait for them to come back to a support level or go up to a resistance level, find support there or resistance there, and then confirm back into the original trend. And that's when you want to get in. Your likelihood of losing is much smaller at that point. You don't have anywhere near as much downside if you're buying at support and selling at resistance. All right, so those are the 4 things that give us an edge over the other retail traders. And this is, most retail traders don't do this, and they don't even have the information to do this. So talk briefly about the compass system. The compass system is a piece of software that I run on Thinkorswim. Again, it runs on Ninja as well. But again, it identifies the highest probability trade setups while sidestepping setups that look good but will fail. In other words, they look like they're a strong stock, a bullish stock, but the institutions aren't driving the trend. And this identifies, the compass system does this by identifying when institutions are driving the move and when they're not. And I'll show you how we do that. It's very complex software. It analyzes complex trading data, but it displays the data in easily identifiable visual format. And this is really important because this allows us, for even new traders who haven't been trading very long, to identify when there's a high probability trade setup and when there's not. And I'll go over how we can see that. So again, we get an edge over retail traders by basically trading with the institutions. We only take trades that are being driven by institutions, only take trades that are being driven by institutions. We trade stocks with relative strength and relative weakness, as I mentioned, versus the SPYs or the Qs, and trade in the direction of the overall market. So those are the things that gives us an edge over other retail traders. And how does this give us an edge? Our trades are going to be being supported by institutional buying and selling. So we know we've got the institutions behind us in that trade. They'll be outperforming the index, the SPY, and they're moving in the direction of the overall market. It sounds simple. It's not simple, but it gives you a huge edge over other retail traders. I wanted to just quickly show you one thing. Let me bring up the compass system for a minute. I want to go to the daily chart. This is the compass system right here, and I'm going to switch this over to a daily, and this is on the SPY. And the reason I want to show you this is I want to show you that this obviously shows you a trend of what the market's been doing. But the important thing is these are the index. This is the indicators that the compass system uses. The most important ones to me is this right here. This is multi-time frame momentum, and this is current time frame momentum. And we have, you can see we have 4 colors. Well, you've got green and blue are bullish, and yellow and red are bearish. So you notice here we've got a green and a yellow. This tells us that there really isn't an institution driving the SPY up or down right now. It's neutral on the daily chart. So we don't really have any great trend to trade here. So for swing trading, we have to be very cautious because we don't really have a market driving in our direction. Now, the reason I show this is I want to go back to when this market turned around initially last year. And it was in November when the market turned. We started to bounce off a low here and the market turned up. And I want you to notice here as we get into, this is November, you notice that all of the indicators now on the daily chart have turned green. Right, so this would tell us that the swing trading can be, you can do swing trading, you can stay in trades longer, and you can be a little bit more aggressive in the trades that you take. And now look as we move along here, and each one of these is a day. Look how long these indicators stay all green across the board. That's a long trend of trading long, and this would tell us that the institutions are overall buying right here, and we want to be then buying. Now we start to get a little chop here in January. This is the money flow. This is a long-term trend, and this is a money flow indicator. It's still showing green, but the momentum is showing yellow right here. So we don't want to be very aggressive here. We're just going to be intraday trading for the most part, and we follow along. And again, we get another period of time where it's all green. Now we can trade long. So this is what I want to show you how the compass system is showing us that institutions are in on a daily basis. This also works on 5 minutes, but that's what we're looking for. You see, we had another nice section right here in February. See green across the board, and then we start to get all this chop. Market pulled back. Notice it went red here. Everything went red, and the market comes down. Momentum is red and yellow, so we get downside momentum, and the market indeed pulled right back. So that way we were getting a lot of chop. We're getting a little bit of improvement here, but the multi-time frame trend's not working. So I just kind of wanted to show you that. To show you what the compass system shows us overall when we look at that. All right, now looking for high probability trade setups in the room. This is what I'm looking for to take trades in the room and to alert people on trades. And it's basically what I call a funnel. It's just a visual funnel, but these are the things that need to be met before I would consider a trade to be a very high probability trade setup. First thing is I always have the daily chart and the 5-minute chart aligned. So if I'm going long a stock, the 5-minute chart the daily chart has to be bullish. So if I'm going long, I'm gonna say the daily chart looks good. Now I'm gonna try to find a good entry using the 5-minute chart. But the daily chart has got to be bullish if I'm gonna go long. I cannot take intraday trades long if the daily chart is short. It takes away all my flexibility. I can't stay in the trade if it goes against me. I can't hold it overnight. So daily chart and 5-minute chart need to align. We want to trade with the trend, both stock and market, if there is a trend in the market. That's important. That's basically just trading with the trend. We're going to be looking at the daily chart and trading with that trend. Now, the key thing here is the compass indicators need to align. If I'm going long, I need to be aware that the institutions are also in that trade. That's the only ones I'm going to take. And then I look at relative strength and relative weakness. And that's really important to take relative strength and relative weakness. We covered that in consideration. And then I want to be near a support or resistance level. If I'm not, I can put an alert on the chart to tell me that. If all of these things are met, the stock that drops out the bottom here, or the stocks that drop out the bottom are going to be high probability trades, and then I would delve deeper into the technical analysis to find the ones that are the best. All right, so this is just what we just covered. I just did it in visual, so you can see it here written out. Identify the market trend for the day. The stock should be traded, should have the daily and 5-minute chart aligned, and the compass indicators must align in the direction of the trade. All right, and this stock should have relative strength and relative weakness. But these are all the ones we just went through. And the important thing here is to have patience. It's important to have patience to wait for these trades to come to you. Okay, now these are the strategies we use in the options room and the alert service. We do straight calls and puts. We do debit spreads using weekly options expiration. We do time spreads over earnings. This is what I'm going to go into in detail today as far as this particular strategy is concerned. People underestimate how effective this particular strategy is, and not very many people do this or even know about this. This has been very, very effective for me over the last 2.5 years or so. We also do what's called weekly ATM strategies. This is a neutral to bullish strategy where we sell puts on a weekly basis to capture the premium on the time decay. And we also have a longer term put out in time to hedge against that. Basically, it's a longer term put at a lower strike price. So if the stock goes against us, it allows us to capture the any kind of losses in our short put by taking advantage of the long put. And we do credit spreads to capture premium over a few weeks. These are pretty common. And then we have, I have a system called the SPY Super System. This is just a setup that I have that's very important. It only occurs when the SPY is at a resistance or a support level, and it's moving back into the original trend. I have institutional buying or selling in the SPY system, and the market internals are also bullish. I have a lot more buying and selling on the bullish side, or selling than buying on the bearish side. All right, so those are the particular strategies that all of our trades are going to come from. So who is the Compass Alert service for? Excuse me. It's designed for day trades and short-term swing trades. All right, this is not an investment service. This is for day trades and swing trades, short-term swing trades. Typically, swing trades going to be overnight to maybe 3 weeks. Sometimes we'll be in them that long, but generally a few days. Again, it's designed for traders who can't watch the market all day. Real-time alerts are going to be on the highest probability trade setups you'll get. And again, how do we find the highest probability trade setups? Well, we just went through that. We're going to be looking for stocks that institutions are involved in, market internals are strong, and has strong technical analysis. That's how I find these. And you have to, they're very specific, and you don't find an awful lot of them. This is just I need to update. This is just a 90-day P&L, but it does kind of show you what our results are like over. This was a 90-day period last fall. It's basically similar every quarter. And so what I'm going to do is I'm going to spend a little time reviewing some of the trades we've had. And the reason I'm doing this is it's twofold. It's to show you basically what our win rate is, but it's important to show you what the expected profitability is on the trades that we take. I don't want people to be misled that there's going to be 3, 4, 5, 600% gains on trades. That's not the case, and there's no strategies that can do that consistently. They'll tell you that there is, but there isn't. So these are the trades in September. You can see we did have 108% gain here in STX, but generally speaking, they're going to be anywhere from 10, 15, 20 up to 40, 50%. And this was our September trades. 25 wins, 2 losses, 92% win rate. Win rate usually is between about 85 and 90% normally. And what I do, he said it was 2,000 invested in each trade, created a profit of 77.88. This is just an arbitrary number I use just so I can compare month to month how the trades are doing. So that was September. This was October. Seeing the same percentages here. We do have losers, obviously. Not a lot, but we have some. We had 24 wins, 4 losses here, 86% win rate. 2,000 produced 44.80 for the month. And again, you see 32, 23, 33, fairly consistent across the board here. November, same thing. And again, I don't need to go into a lot of detail on each one of these trades, but you can see what our profits are, or what the trades that we lost. You can see some of the different strategies we have in here, and what they produced. But again, a good month, 21 wins, 4 losses, 84% win rate, but decent profit, 51.60 in November on 2,000 invested in each trade. This is arbitrary. You can put 500 into a trade, you can put 1,000, you can put 10,000. You just depends on your own risk tolerance and what your account size is like. But this shows you what the percentages is. So obviously, if you used 1,000, you would have been up about half of that. So that's how it correlates. December trades, really slow month. Didn't have an awful lot of trades here. 16 trades, 14 and 2, 87.5% win rate. Didn't do a lot of trades in December. Just didn't do a lot. It was coming up on holidays. It wasn't really great trading. January, a nice month in January. And again, you can see the percentages here. Here's the time spread here at 39%. I'm going to be showing you a bunch of time spreads. But we have here we have 43% in Zim, 37 in Vertex, another 32 in Vertex. So you see that again, the results are very similar month after month. We do have losing months. I've had 3 losing months in in 29 months, 3 losing months. Very small, you know, 1,000. One was $246, one was 1,000, one was about 1,400. That's the extent of the losses so far, and that's fairly consistent for. The room has been open since January of 2022, right when the bear market started. So we've had this is our 29th month here, I think. Yeah, 29th month, and we've had 26 winning months and 3 small losing months. February, pretty nice month. Again, 92% win rate, 24 wins, 2 losses. Big profit in February. February, we were able to stay in some of these trades a little longer. Profitability is dependent upon the market more than anything else. If the market is trending, you can stay in the trades longer so you can squeeze out more profits. If it's not, you got to cut the profits quicker because it's choppy. So the market has a lot to do with profitability. But again, this was $11,745. This was a pretty big month for us in February. And I broke out the alerted trades here. The alerted trades in February, 20 wins, 2 losses. So you see, we had 26 regular trades in the room and 22. So we had four less trades in the alert service, because sometimes the alert service, I don't want to send them out if I'm only going to be in the trade for less than an hour, half an hour, because it doesn't give the alert folks time enough to receive the alert and get in there if they're not looking at their phone. And also, if I do an alert at the end of the day, like I get into a trade at 345 or 350, I'm not going to alert on something like that. So that's why there's a difference in those. But again, you can see the profitability is pretty nice. So the first quarter of 2024, this was the profitability that we had in the trading room: 65 wins, 11 losses, 86% win rate, which is right on target, about 18.7 as far as profitability is concerned. And over here on the alert service, in this first quarter, we had 41 wins and 6 losses, 87% win rate, and 12.2 as far as the profitability was concerned. So I just kind of want to be transparent with that. This was the whole of 2003. If you invested 2,000 in each trade taken in the Compass Options room, it produced a profit of a little over 60,000. Using an account of 50,000, and I'm just using this as a hypothetical. Each trade, and initially when you started the year, would have used up 4% of your account balance. But doing this 2,000 account, it produced 120% return on the initial 50,000. So the balance at the end of the year grew to 110,000. And that, of course, if you were putting still 2,000 into a trade at the end of the year, you would only have been using 2% of your account balance for each one of those trades. Robert, how many trades per week? You know, Robert, it varies a lot. This week we had about 5. Usually somewhere between, sometimes as low as 3 in the alert service, and sometimes as high as about 7. That's about the. Normally, I don't want to have more than about 4 or 5 trades at the most open at any one time, because it takes up too much margin for a lot of the traders. So it just depends. But you know, I think this week we had 5. I'll show you some of our closed trades just in the past couple of weeks. These are the alerted trades in May that we just where we are right now. This is all the alerted trades in May that we've done. Now, and I did this for 2 reasons. I wanted, obviously, you can see the percentage gains fall right in range with the other things that we had. We've had 12 wins, no losses here, and a profit of 78.92, so pretty nice. But I want you to notice here, we have 5 time spreads in May that we've done so far. And time spreads are very specific. I'm going to go over why they're very specific. We don't do as many. Robert, to put 2,000 in each trade, you need what size an account? Well, if you're day trading, you need to have a $25,000 account. But if you're not day trading, you know, I would say to put 2,000 into each trade, you probably need to have like a $30,000 or $35,000 account to not be worried about having some losses wipe out the account. All right, so we did again. We've done 12 wins and 0 losses here on the. This is the alerts, and I just wanted to show this because I'm going to go into the time spread strategy, and I want you to see how these have worked so far. 30, 40, 48%, 38%, 71. This was a kind of a lucky one that we get into. We did put the time spread on before earnings, and we're actually able to get out before earnings because of the implied volatility and the options really spiked up, and we were able to get out. But this was the May alerted trades that we've closed. All right. So how are you going to get these alerts? If you're interested in the alerts, you're going to you're going to basically get it by, obviously you're going to get them on your smartphone through SMS. It's going to include the stock symbol, the option strike price, the option expiration date, and the price to pay for the option, which could be a range. You could say $1 to $1.05 or something like that. And usually I'll send out alerts with the entry initially, and then I'll send out another alert with the exit, whether we're exiting to take a loss or exiting to take profits. Generally, we're exiting to take profits, since that happens about 85 to 90% of the time. But when you get an exit price, it's good to create a good till canceled order on it, so it's working for you in the morning when the market opens, in case you're not there. All right, so just to kind of go over how we get these great results that we've got. And this is really kind of important. I think it's important for people to understand how we get these results. What kind of methodology and strategy are we using? I know a lot of people just want to make money, so they just want to take the trades to make money. But I think a lot of people want to know how it's done, because a lot of people want to learn to do it themselves. So again, we were able to identify when institutions are driving a trade and then when the market internals are heavily bullish and bearish. And I showed you that with the compass system. I'm going to go into more detail. We only take trades when both of these are in our favor. Well, if the market internals are neutral, we'll also take trades as long as the institutions are driving the trade. So again, skip the best, trade the best and skip the rest. We do a combination of market internals and the compass trading system to find institutional trading. I'll go over in that. This is what this is. This is how we're able to get this kind of results. Now, how we find them in the compass system. The compass system does three things for us. It does what's called a triple screen assessment. Triple screen assessment is basically it's fractals, or it's what's called multiple time frames. So it's looking across multiple time frames at these three things. It's looking across on momentum, trend, and money flow. If you've got a stock that has got momentum across multiple time frames, all going bullish, trend across multiple time frames, all going bullish, and the money flow derivative we've got also bullish across the daily chart, then the likelihood that you've got institutions driving this trade is astronomically high. It's just very, very likely that the institutions are driving the trade. It's be very rare for them not to be in the trade. Doesn't mean they're going to stay in the trade, but it means when you get in, they're in there. All right, so I'm going to spend some time here on time spreads. Now, I've not done a general video on this before, so I want to explain about time spreads. And these are, you might know them as calendar spreads. These are trades that are taken over earnings. You enter them just before earnings, and you take profits right after earnings generally, right? I call them time spreads. And we take these in the room all the time, and you can see we had 5 of them on the alert service this month, all profitable. So these are the time spreads for this year. And I tried to list every one. I may not get every single one, but it's, again, over the two plus years I've been doing this, 85% win rate. And we have some losses, not a lot though. So these are the ones that I've had that I went back and tried to catch since the first of the year. Now, remember, your earnings season is every quarter. So when the earnings come out, it comes out the first couple of weeks, first 2 or 3 weeks in January, second week, third week in January. So typically you're not going to have any trades just before earnings come out because you don't have any earnings. But once the earnings come out, you see now we started taking trades in January, and then there's more earnings in February. And now as of April, which is that was the beginning of the end of the second quarter was March. We have earnings coming out in April. So April and then into May, you start to get a lot more time spread trades because you get a lot more earnings to go from. So these are the trades that we've taken right here up through this past week. So we've had 28 wins and 4 losses, 32 trades, 87.5% win rate. This number keeps popping up. This is typically what we're winning on these things. But again, you see the percentages are really nice here. There's that XP one I showed you, but we had Akamai just on the 9th. We had Hershey's on the 2nd. We had Sedge on the 8th. We had Applied Materials on the 16th and TJ Maxx on the 21st. We just did this one just this week for 38%. So this is what time spreads are. So I want to explain how this strategy works, why it works, and why other earnings trades don't work. Most earnings trades will never work. And the reason for that is that market makers, before a stock goes into earnings, when it's getting ready to have earnings, market makers increase the applied volatility on all the option prices, because they don't know if the stock's going to go up or go down after earnings, and they really don't know how much it's going to go up or go down. They estimate, and then they create the premium on the options based on what they estimate. So if they're putting prices on Microsoft for earnings, and they think it's going to move 10% up or 10% down, then they'll price the options to move 10% up or 10% down. So they'll jack up the option premiums on all those. It's called implied volatility. And if you're trying to take like a strangle or a straddle on something, in other words, you're trying to bet that the stock's going to go up or going to go down by more than 10%. If it doesn't, then you're going to lose money on both the puts and the calls, and you're not going to be able to do this with standard long calls or long puts on options. No matter what anybody tells you, nobody knows what a stock's going to do after earnings. They're guessing, and if it doesn't exceed what they expected, how they expect it to move, then they're going to lose money on no matter what strategy they use, except for time spreads. And this is a strategy. It's a calendar spread, right? So it's the only one I use over earnings. I put these on stocks just before they're going to report earnings. And when I say just before, if the earnings coming out after the close or before the close the next day, I'll put them on this afternoon, sometime in the after lunchtime. All right, so we're going to put the trade on just before prior to earnings being released. I mean, just before, it could be a half an hour before. And what the trade does, this is how it works now. It's meant to capture the difference of the IV crush and the time decay between this week's and next week's options. So when a option on a stock into earnings, when earnings are coming up, the implied volatility is going to get jacked way up this week because earnings are coming out. And the implied volatility next week is going to be lower because earnings will have already occurred. What we're doing with this strategy is we're capturing that IV crush. In other words, when the earnings come out, as soon as the earnings come out, and the market makers now know how much the stock's how much it moved and which way, then they pull out all the premium out of those options, or not all of it, but to pull out a lot of the implied volatility out of those options, so the price drops down. So what we're doing is we're capturing the difference of the IV crush and the time decay. Remember, options that expire this week have a much faster time decay than options that expire next week. So we're capturing the implied volatility crush and the time decay between this week's and next week's options. This is the meat of the strategy. Now, how you do that is a little bit more complicated, but that's what this does. This trade works best on stocks that historically don't exceed their expected move to after earnings release. So harvesting premiums from the options can be profitable. Now, I'm not talking about what the earnings are. I'm talking about how much the stock moves, how much the stock price moves after earnings are released. And what we're doing is we're looking for stocks that historically don't beat that. Let's say they're expecting Microsoft to go up or down by 10%, and 80% of the time it never even gets that far. It's less than 10%. Those are the stocks we want, the ones that historically do not beat the move, not the earnings, but the stock price doesn't beat the move that the stock price takes. All right, those are what we're looking for. And the time spreads, of course, they're entered as a debit, and that is the total risk of the trade. And it should be entered as one transaction. I'll show you how we're doing that, because we're basically selling this week's calls and buying next week's calls. It's one trade. We're selling this week's calls because the implied volatility is going to drop. So when you sell a call, you can buy it back cheaper when the anticipated or the implied volatility drops. Okay, so this is the basics of the strategy. Now, again, they're initiated on stocks reporting earnings tonight or tomorrow morning before the open, and it consists of selling this week's expiration at the money calls. You can use puts too, but I use calls all the time. But selling this week's expiration at the money calls and buying next week's calls using the same strike, and this is going to cost you money. So let's say you can sell this week's calls for $2 and buy next week's calls for $3. Right? It's going to cost you $1 because you're selling this week's for 2, buying next week's for 3. And what you're going to do is when the implied volatility crushes, you can buy back the ones you sold for 2 for maybe 1, and next week's will remain at 1 or go up to 1.5. So you'll have made pretty good amount of money on that. Okay, so it may seem a little complicated. It's really not. Finding the criteria is the hardest thing. Again, after earnings are released, the implied volatility will be drained, or it's called IV crush, is what it's called in the business. It's an IV crush. It's going to be drained from both this week's and next week's options. However, the IV is higher for this current week's options because it's close to earnings versus next week's options, giving us a profit. If the IV drops, we're automatically going to have capture the difference between the IV drop between this week and next week, because this week's implied volatility is higher than next week, so it's going to drop more. Additionally, the time decay is going to impact this week's options more than next week's options. So the time decay for ones that we take, like we took on Wednesday, the time decay for the short calls that we wrote for this week is going to be much faster than the short calls for next week. Next week's going to deteriorate more slowly. So now we've also captured the difference between the time decay. So we've captured the difference in implied volatility when the IV crush occurs, and we've captured the difference between the time decay between this week's and next week's. This is what gives us the profitability in this particular trade. And you notice we don't care whether the stock goes up or goes down. It doesn't make any difference to me if the stock goes up after earnings, go down after earnings. I don't really care as long as it doesn't exceed what the expected move is expected to be. And since we're taking stocks that historically don't exceed what the move is going to be, we make money on the trade. I mean, it's as simple as that. Okay, when this occurs, it allows us to buy back this week's options and sell next week's options. Obviously, we're reversing the trade. Since we sold this week's and bought next week's, now we're buying back this week's and selling next week's. Usually we can make 15 to 50%, sometimes a little bit less, sometimes a little bit more. Generally, it ranges in about the 35 to 45% range. And it typically is done in the morning. Now, they don't all work, and I'll go over that. But this is the bread and butter of how this strategy works, and it's been very, very effective. All right, so what is volatility crush? And I just kind of told you what it was. Volatility crush is the additional premium included in the option price prior to the earnings date, due to this uncertainty of the stock's price reaction to the earnings report. The market makers don't know. Nobody knows which way the stock's going to go and by how much. So they add premium to the options, puts and calls to protect themselves. I mean, that's basically what they're doing. They're trying to protect themselves against these moves. Immediately after earnings are released, the additional volatility that was included in the option premium drops rapidly or is crushed. So this happens if a stock reports earnings after the close or before the close. When the options open in the morning at 9:30, they're going to know which way the stock went and how much. So they're going to immediately start pulling premium out of there based on the implied volatility drop. It won't come out in the first couple of minutes. And what you're going to see after earnings is there's going to be a big wide spread between the bid and the ask on the option prices, and that's because they've got the implied volatility in there and it's starting to come out, but your bid and ask can be pretty wide. This actually helps us because sometimes we can get filled for a higher price than we normally would because the bid and ask is so wide at that point in time. And if you select stocks that have specific criteria just prior to earnings, the volatility crest can be captured for nice profits, and this is how the strategy works. All right, so this is what the strategy is doing. It's capturing volatility crush, but you got to know which stocks that's going to work on, because if a stock exceeds the expected move, then it becomes a negative for us, and we have to sometimes make adjustments for that. All right, so all the trades will be calendar spreads. I call them time spreads. They're actually calendar spreads, but they're time spreads because we're specifically using this week's and next week's call options. The time spread is structured to capture the implied volatility drop after the earnings are released and the difference between this week's options volatility and next week's options volatility. That's the meat of the strategy right there. And the strategy also captures the difference between this week's option time decay and next week's options time decay. All right, so this I'm trying to explain it as clearly as I can. It's not all that complicated, but I want you to understand why these things work. It's again, the trade is entered just prior to earnings. Enter the trade in the afternoon before earnings release occurring, after the close, or before the open of the next morning. So you've got to get these trades in before the market closes the day before earnings. And again, we try to take 20 from 40%, 50% right after the open in the morning. So always when I have a time spread on, I always have an order working at the market open. I'll put up, if I paid $1.25 for it, I'll put a sell order in for $1.75 or $2, and I'll have that working when the market opens, because that's the wildest time with these option premiums, because they're fluctuating all over the place. And a lot of times you can get filled for a really nice price. I mean, I had one that I had, I was aim at, I had a $2, I got in for $1.20, and I had a $2 sell price on it, and they filled me right at the open, like 9:30 and 30 seconds. But I got $229 for it. And some folks in the room got $265 for it, that we get in for like $1.20. And that was because of this big, huge spread with the volatility and the premium coming out, but creating wide spreads when it did that. All right, so that's how time spreads work. So how do I find these? And this is a little bit tricky. I have to spend time finding these, and I've got ability to find these criteria, but obviously it's got to have weekly options, because you're going to be trading this week's and next week. So you have to have weekly options in the trade. And obviously the stock has earnings announced after today's market close up, prior to market open tomorrow morning. We've covered that a couple of times. I look for the implied volatility difference between this week's option and next week's option to be a large difference, at least 40%. 40% or more implied volatility difference. You know, if this week's volatility is 120 and next week's volatility is 60, I basically get a difference of 50% between this week's volatility and next week's volatility. That's a good volatility difference. I'll take them, you know, 40, 41, 42%. Not taking anything that's got 20% volatility difference, because it doesn't give me a big enough edge on this trade. Historically, this is a key thing. Historically, the stock should move less than expected move at least 80% of the time or more. So I don't want this stock not beating earnings, beating the price movement after earnings. I don't want it happening more than 20% of the time. All right. So, and I have a program that I use to find that a guy I know wrote. But this is a little trickier to find. But this is how I find these. The stock should lose less than it should have beat the expected move. At least 80% of the time, it should fall below the expected move. And the less frequently it exceeds the expected move, the better. Some stocks have never exceeded the expected move. And those are great. I mean, it's 0% beating the expected move. You can figure it's going to stay inside the range. Again, enter the trade the afternoon prior to tonight or tomorrow morning's earnings release. Close the trade for prior after the market open if possible. If the stock price moves more than the expected move, you may have to take a loss or take an adjustment. Now, there's a couple of things here, and I know I'm spending quite a bit of time on this, but if an expected move is, let's say it's 10%, and the stock goes up 20%, then you're going to have to close that trade out that day, because you'll be risking assignment on your short call. But if the stock drops 20%, then you can stay in the trade by just holding on to this week's short call, capturing the premium, and holding on to next week's long call, looking to see if the stock bounces. And so there's two things that happen when that causes. That's why I call we take an adjustment in the trade, but it depends on which way it moves. All right, so that is time spreads. Is there anybody got any questions on these things? Okay, Paul, what happens if the stock unexpectedly goes way up and you get assigned? Wouldn't you have to have enough money in your account to buy back the stock? And two answers to that. First of all, you're not going to get assigned that during the day like that. Generally speaking, it's going to happen at the end. But no, you're not going to don't have enough money. Don't have to have enough money in your account, because remember, if you get assigned the stock, in other words, you're short the stock because the short call created an assignment to you. All you have to do is use the long call for next week, which is at the same strike, by the way, to buy the stock back and cover your assignment. And at that point in time, your loss is what you paid for the time spread. You can't lose more than what you paid for the time spread. Your long call will cover your short call. That's why you do it like that. Okay. Anything else anybody has? I know it sounds a little complicated, but the results in this thing are really pretty astronomical. They're really, really good. It's a low probability loss or a low risk type trade. All the trades I take are what's called defined risk. You can't lose more than what you put into the trade. I don't take any naked calls or any naked puts on anything. They're very, very risky. All right, but that's how this works. So hopefully that makes sense to you. And again, this will be recorded, so if you need to go over it again, but this is a very way overlooked strategy to make really good money on time spreads. Could you sell weekly and buy 30 days out instead of buying the next week's? But the problem, if you don't use next week's, Peter, what's happened is that if you go out further in time, right, you're going to be, when you're buying that, you're going to be paying more for it because you're buying more time decay when you go out that. So you don't take advantage of the time decay difference between this week's, because remember, this week's time decay is going to be fast. Next week's is going to be slower. If you go out even further, you're going to be paying more time decay. So it's not I would not recommend doing that. Paul, can I give an example of an adjustment trade? Well, yeah, I mean, listen, what I've done, let's say the stock, if it goes up, I can't do too much about it. If I'm short calls and it goes above my call price and I don't want to risk assignment, then I typically will close the trade out. Now, if you're an aggressive trader and you think the stock's going to keep going up, you can buy back that week's call that you're going to have to buy back at a loss and hold a long call, expecting the stock to keep on moving up. That's one way you can adjust it. If the stock goes against you, then what I usually do is I'll analyze the technicals on the stock when it goes down, and if I feel like the stock's going to bounce, then I'll just hold on to next week's long call. If I feel as though the stock is really bearish and it's going to continue down, then I'll go ahead and sell this next week's call and I'll buy puts, and I'll take those puts and make money on the downside on the stock if it continues down. But I need a day or so, a day or two, to make that kind of a decision to make sure that the stock is actually going to continue on down. Okay, yeah, that's how it works. I mean, I do make adjustments to these things. Listen, these things work most of the time. Like 85 or 90% of the time they work. So you're not making a lot of adjustments. Your risk is limited to what you put into the trade. So it's all in all, it's not a stressful type trade. That's what I like about them. But they're quick, and you've got to have those. You've got to have that sell order in and working when the market opens in the morning. I mean, that's really important, because most of the time I get filled right at the open because the spreads are moving all over the place. And again, a lot of times I'll get filled at a higher premium than what I was expecting because of that wide spread due to the implied volatility crush taking place. So I just put a sell order in for what I anticipate, which is 30-40%, and then a lot of times I'll get filled at a higher price. And if I don't, then I just can make adjustments to it as needed. All right, so this is a time spread. I use it in the room. I use it on alerts. I don't know too many. I don't know very any other services that do this. I mean, I know plenty of services that do earnings trades, but they're trying to determine which way the stock's going to go and how much it's going to go. We don't care. That's what's nice about this. This is a non-directional trade. The stock goes up, the stock goes down. We don't care. As long as it stays inside the anticipated expected range, and we've got a stock that doesn't usually beat the expected range, then the likelihood of winning on the trade is pretty high. All right, so that's time spreads, and I hope you found that interesting and helpful, because it's a lot of it's not a huge percentage of the trades I make, because I can only do it during earnings seasons, but it's a lot of trades. As you can see, we had 5. If I go back, I can show you the time spreads we had here. Boop, 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 back here. Yeah, so these are the May alerted trades, all right? There's 12 trades here. We get 5 of them are time spreads. Almost half of them are time spreads in May, because we had some nice earning trades to take. Again, I can only take them when the criteria is met. Peter, is the calls puts the same outcome? Well, I found that the calls work better, just because of the premium on them. And if you've got calls and the stock goes down against you, the market, generally speaking, over time goes up. So there's a much better likelihood than not that stock is going to bounce and head back up again. So I'd rather be in the calls. as in the puts. If I'm taking puts and the stock goes up, the likelihood is it's going to keep going up, and that those puts are going to be, I'm just going to close out. But if it drops down and I'm short puts, then I'm in a position where I could be assigned the stock. And is it likely to keep going down? I don't know. It's not as likely to keep going down. So that's why I use calls. And I've found over my experience using these that I get better premiums by doing calls than by puts. But the outcome can, I mean, if it stays within the range, the outcome is going to be very, very similar with puts and calls if the stock stays within the expected move. How often do I take a simple call, a put trade versus an option spread trade? I mean, I'm just guessing because I'd have to go back and look at stats. I do take a lot of calls and put trades. I mean, probably I take spreads, debit spreads, which I typically do on a weekly basis, and time spreads I do during when I have some good earnings. I would say the number of trades we take that are straight calls and straight puts are probably in the neighborhood of about 60 to 65% or so. Pedro, do I use at the money strikes for the time spreads? Yes, I do. I'm taking at the money at the time I take it. I'm going to take it I take whatever's the closest strike. If stock's trading at 29.75, I'll take a $30 call and I'll use as close to at the money as possible on that. Okay. Yeah, and Paul, yeah, I would say with the 65, maybe even 70% of the trades are straight puts and calls. I'd have to look and see, but a lot of them are that way. I mean, a lot of them are that way, and that's the meat of the system as far as it's fairly simple trades. When I get out of them is dependent upon what the market's doing. So, all right. So what I want to do is spend a little bit of time here on the Compass system and some of the results we've got with this, just so you can actually see what I'm seeing when I take a trade. So that you can see this. This is the Compass system on Thinkorswim. This is Tesla. This was one we took a while ago. I just kind of want to show you. This is a 5-minute chart. You can see all green here. Anybody can see that the institutions are buying here. I mean, anybody can see that they're buying here. So this is a stock moving up. These are Heikenhachi candles. I use these sometimes, but that doesn't really matter here. You can see how smooth this move is in Tesla. So this is one we used. This was a Heikenhachi reversal. I do Heikenhachi candles, and I actually do a video on that sometimes. But these are Heikenhachi trades. But you can see, I want you to see the institutions are buying. Right here, the institutions are buying. We just have long-term trend has gone yellow because of this chop, but everything else was green, and we took this trade right here. All right, and I'll go through a bunch of these. This was a Heikenhachi trade. All right, so these are some of the trades we've taken in the room that aren't necessarily, I was using that for Heikenhachi. These are some of the standard trades we take. This is a daily chart. All right, so this was we took workday. We actually took it right back here, workday long. The arrow's in the wrong spot because everything, when you see how these went yellow, blue. So we get in right here. Now these were going back and forth between yellow and blue, so I had to be cautious of this. But this was a day trade, and if you look at this shaded area, that's called the dynamic compression zone that the Compass system actually produces. And this was a breaking out of that dynamic compression zone. So that's where we took that for 5 days for 30% profit. This was MDT. Again, everything went yellow to blue. Everything was green and blue. Institutions are buying, we buy. Buy it here, get out here, 25%. VKTX, same thing. Everything was green. Bought here, get out here. We're in 3 days, 30% profit on that. McDonald's, this was just overnight trade. In for $8.30, out for $11.30 the next morning. The $3 contract gain, 37% gain. See the breakout of dynamic compression? This is something that the Compass system produces. It's called a pop out of the box symbol or a pop symbol. It tells us we're breaking out of compression. We get in right here as it comes out of this dynamic compression. Take it overnight. Nice winner. Moderna, nice loser to the downside. Look at the red and yellow. Compass system telling us without any question that the institutions are selling here. And this is a 32% profit at Amazon. We were just in this for the day. Excuse me a second. All right, sorry about that. My dog wanted to go out. So yeah, this was Amazon. Again, we just took this. This was actually a day trade. We took it off of this candle. We just intraday traded it for 32%. JD for a nice drop down here. Again, you see this, that went from green to yellow, bullish to bearish. Everything else was bearish. Time to take it's dropping out of the dynamic compression. We take it right here, 61% profit in JD. So just so you can see what the compass system is doing for us here. It's really giving us just telling us that the institutions are selling here. This was Datadog. This was another one. You see, we was chopping around. Comes out of dynamic compression right here, and everything is yellow or red. We just take a 21% profit on a quick overnight trade. Crowd, same thing. Again, we had to watch this. We were getting multiple time frame choppiness, but the current time frame went blue, and this was green. So I took it here, and then I stuck with it. I think we just actually stayed in it for that day, but that was a 20%. It was right after earnings. You see here, that's earnings. Amazon, again, another nice trade here, 32% profit in 45 minutes. This is a 5-minute chart. Now I would have looked at the daily chart. It was bullish. The long-term trend was yellow, but everything else was green. So I'm happy with it, with the multiple and current time frame momentum all green. Happy with that. And this bounced up nicely. This little green line here, the compass system produces, that's a 15 EMA of an EMA or a smooth EMA, and that's one of the levels that we use for support and resistance. This is ENPH. This was another short on a 5-minute chart. See the compression, stock moving sideways, everything red. Institutions are selling, pop out of the box signal, coming out of compression, down we go, made 20% in an hour. Again, everything's red here. This pink line, by the way, is a VWAP with a volume weighted average price. This is another good support and resistance level that you can use on the 5-minute chart. Not on the daily chart, but on the 5-minute chart. Verizon, this was a really nice one. This one we get in for 45 cents. We took next week's puts in the money on Verizon, only cost 45 cents because the stock doesn't move much. An hour later, we get out at 67 cents. So if you bought 10 contracts at $450, you would have collected $670 in an hour. All right, and this is a SPY super system setup just to show you. Again, we bought the SPY super system here. We bought the SPY puts because we had everything red. We knew the institutions were selling. The market internals were bearish at this time. We get a compression break to the downside. We stay in this, but I don't alert on these because they're typically too quick. They're usually only maybe 3, 4, 5 candles long. This was Netflix, nice profit on this one. Coming off and see this VWAP, breaks below the VWAP, we take it here, took 20% profit in Netflix. And this was Tesla. We trade a lot of the big names, of course. Tesla had a pop out of the box, bearish one here. Everything was yellow or red. Buy it here. We get out right at the end of the day for 30% profit. That was a nice trade. And this was when we took overnight. The daily chart was showing me bearish. We had all yellow and red at the end of the day with the pop symbol. So we took it overnight. And we got lucky. The stock dropped from 120 to 112. Our options popped about $7 when we get out right down here. You know, it's still bearish. The market is still selling it off. And you've seen that one already. Now, this is just so I can show you a daily chart and a 5-minute chart and how we use it. This is a daily chart of QSR. All right, so this is QSR, is a daily chart. And you can see that we had, when we got here, everything was blue and green. So I like QSR here for long. So I switch over to a 5-minute chart. This is the 5-minute chart of the day right here that we actually bought it. So I'm looking for an entry on this, and I'm using the compass system to tell me right here. I take a trade entry right here, I pop out of the box. Everything is blue and green. Now it goes yellow, so I have to watch it here. But I still had green here, and then it went back to green again. So we just stayed in this. And this is the 5-minute chart, and this is how we rode this trade up. Because I knew the daily chart was bullish. This was a nice entry, so we took it here. You get a little concerned here, but we stayed in the trade and it worked out fine. All right, so again, I'm just gonna kind of wrap this up here. These are the strategies we use in the option room. Straight calls and puts, about 65% of the time, as somebody asked about that, probably 65 to 70. I use debit spreads using weekly options expiration. We had a nice one this week on Lulu on debit spreads. We used a put debit spread for Lulu for a nice gain. Time spreads, which we just spent quite a lot of time on here today. the time spreads over earnings, which is a calendar spread to capture volatility crests. Hopefully you get the details of how that works and why it works. The ATM strategy, which captures premium week after week by selling puts against a longer dated put. And if the stock continues neutral to bullish, you can just keep collecting premium week after week. And then we do standard credit spreads, which have a long put and a short put that expire on the same date with two different strikes to capture the premium between the two. And then SPY Super System. So that's all of the trades that we take here. I don't take any condors. I trade butterflies, but I don't call out any butterflies. It's a little bit more complicated, so I don't do that. All right, so and here's the text alert service that we talked about. And these are the specials we're offering today. And this is a really good specials that they put out if you're interested. This is the alert service itself, 50% off. If you take the alert service, you get a month in the room, the trading room. We have a Discord room. We have 2 other professional traders who trade all day, and you can use that room for looking at their charts, asking them questions, like audio. They'll talk to you about it. Then I have about 25 to 30 videos on what we call the wise way to trade options. But all of the strategies that we use, time spreads are in there, as well as everything I use is in there, as well as the indicators and how to find high probability trade spread setups. So that is the Memorial Day sale for the options alert service. And these links should be in the chat box, I'm pretty sure. Let me look. I don't see them in there yet, but they should be in there. And so that's the, let me just check on something here. Hold on just 1 second. All right, so they just put the links in the chat box. Chat box now has all the links for the specials that we're covering. So this is the first one. This is the alert service. Again, 50% off. This is $9.99 for $9.98 for the whole year. You've seen what it produces, so you can see how good that is. And again, you'll get the room for a month, and you get access to the Discord, and you get my videos. This is the trading room itself. If you want to get in the trading room, now if you take the trading room, it's only $11.98 for a year, and you get the chat, and you get the SMS text alerts. So you're getting the alert service and the room for $11.98, as well as the way to trade options, my videos on this. So that's the trading room. This is the Compass system itself. Now, Compass system itself is a software that goes on Thinkorswim or on NVIDIA or Ninja. Got NVIDIA in my mind here after this week. It goes on, but I run it on Thinkorswim. Now, if you get the software, this right line text will put that on right on your system. Sergio will put that on your computer. It takes over your computer, puts the software on there. You don't have to do anything. It'll look exactly like mine. I mean, it'll look exactly like mine. It comes with a bunch of different scanners, and you'll see exactly what I see. In other words, it's going to look like this with the scanners over here. This is what it's going to look like with all the indicators and everything. It'll look exactly the same. So you would be getting what my workspace looks like. Now, for Memorial Day here, if you're interested in either the live trading room, if you're interested in the live trading room, and you take a year, you get a year of the live trading room, you're going to get the Compass system for nothing. You get the software that goes on your either on your TOS or on Ninja. You'll get that for free. So, man, that's really a spectacular deal for Memorial Day. So you buy one, get one free. You buy the trading room, you get the Compass system to use for yourself. So you can use it to trade your own stocks. You can always look at your own prospects on there and have the Compass to tell you whether the institution's in there or not. So that's those are the specials. Again, here they are. The alert service, and again, there's links in the chat for each one of these. The alert service, 50% off. The options trading room, also 50% off, and the Compass system is 50% off if you just want to buy that. However, if you want to get the Compass system, you're better off to actually buy the trading room for a year and get the Compass system for free, because that's a massive savings on that. You're actually getting the software for free. I don't know that we've ever given the software away before. So those are the specials. Let me just check, see if any questions. I don't see any more questions out here. We had some good questions in here today, though. Pedro, can you download the Compass trading system in the Interactive Brokers platform? I don't believe it works on Interactive, but here's the key here. I run mine on Thinkorswim, all right, the Compass system, but I don't trade on Thinkorswim. I used to trade on Interactive Brokers. I don't anymore. I trade on Tradier using TradeHawk. But the point is, you can have the Compass system running on TOS, and you don't have to pay for TOS. You can get a platform. You can get the TOS platform for nothing, I think, and it'll just Thinkorswim. It'll stay out there. You can load the software on TOS, but you can trade on Interactive or anybody else, Scott's or wherever you use. I use the Compass system to find my trades, but I trade on TradeHawk through Tradier. So I'm not using the same platform as where the Compass system is. So you don't need them. You don't need the Compass system. You don't need the Thinkorswim to trade on Thinkorswim. You just need Thinkorswim to put your Compass system on there. Then you can take the trade any platform you want to. Okay? Okay, that's fine, Pedro. Good. All right, so listen, I appreciate everybody being here today. Appreciate you giving up some time on your Memorial Day weekend. And it's a good weekend to take a break and got Monday off. But hopefully I'll get to see some of you folks in the room or on the alert service come next week. I'll be back in the room on Tuesday. We have a few trades on, not a lot. We took profits in about 7 trades this week. So we got a few, but we still have a few trades on. And we took WOOF, by the way, WOOF, if anybody's interested in a nice setup. WOOF, WOOF, Petco Health and Wellness Company, a nice setup, doesn't have any earnings till 8/22, a nice trade to be looking to take a long on. Options are relatively close to intrinsic value or close to parity, so they're good for those. All right, everybody, have a great weekend. Enjoy it. Paul, thank you very much. Appreciate that. Hope to see some of you folks in the room on the alert service come Tuesday. Enjoy your weekend.